Hello, and welcome to Your Place, where we have lively, informative discussions with successful dealers and industry consultants about news topics shaping the industry. I'm Dennis McGinn, founder and chief executive of reconditioning company Rapid Recon. 3 times a month, we visit guests at their place of business to discuss topics that are impacting and shaping your industry. We look forward to visiting your place soon. Today, I have the opportunity to talk with Stephen Greenfield. Stephen is the principal of Automotive Ventures and is quite knowledgeable about the M&A activity, what's going on. We're going to get his impressions, and then we're going to talk about the electric vehicle transition, what's going on in the industry, and how it's impacting dealers and their decisions. Thank you, Steve, for being here. Stephen, maybe you could just jump in here. There's so much going on in the industry, it kind of makes your head swim. And I'm sure you would be a perfect person to kind of give us a perspective, because I can dive off the deep end here and go into this thing and wait around. But I'd rather have somebody like you that knows the business really well and tell us what the heck's going on.
Yeah, so as you say, Dennis, first, thanks for having me today. It's a pleasure connecting with you again. It's been a few months. The M&A activity within automotive is really just hard to keep up with at this point. There's so much of it. And, it's being fueled by a few things. One is, and maybe most importantly, is, we came through COVID and now an inventory shortage, both of which I would imagine we're going to get into today. But, the U.S. consumer has been very resilient and is still buying cars. And, now with inventory shortages, they're paying full MSRP and they're paying more for used cars than they've ever done before. And dealers are not discounting. So dealers and OEMs are printing record quarters of profitability. So they're feeling particularly good. I met with some dealers this week out in Dallas and, hearing from them, whereas in the past they would be, running at about 2% net income. This last 12 months, they've been running at 6 to 7% net income. So that's all flowing through the bottom line, which is great for dealers and the OEMs as well. But, despite that, we're doing that in spite of the fact that we're running so low on inventory. I met with a dealer out in California this week, and, he's selling 200 new cars a month. And he's got 20 in stock. So he's selling 200 a month off of 20 cars that he's keeping in stock. And literally as they come off the truck, they're going into consumers' hands. So I think there's that dynamic, which is like really propping up just the optimism in the industry. But then you throw sort of like rocket fuel on top of it with a low interest rate environment where no one wants to put their money in the bank right now. So they're out spending it on either goods, cars and such. They're putting it in the stock market. And, the third dynamic is because the interest-bearing asset classes are not performing well because interest rates are so low. You've got more money than ever, literally trillions of dollars sitting on the sidelines in venture capital and private equity funds that needs to get deployed because those fund managers don't make any management fees unless they're invested. So that's driving up valuations. It's driving up this voracious appetite for M&A.
We've seen just a slew of groups acquiring other groups recently. And that has to be because they're flush on one side. They've got the capital, starting with DeBoer at Lithia and so on, who's been doing this for quite a while. So they're using their equity and they're using their positions to do this. And then I assume on the buyer side, they're being advised that you're never going to see better valuations. And it is probably just not, I would guess we're pretty far into this thing, but I doubt if it's very far over. What are your thoughts?
Yeah, so I think in terms of physical buy-sell of dealerships, there's a few dynamics in play, right? So as you said, because dealers are profitable, they've got cash flow, they can redeploy it and buy stores. I think the public groups, we saw, Asbury this week with Larry H. Miller, but we've seen, as you say, Lithia being very voracious in their appetite. They have an inflated and high stock price now. So the difference between their stock price that they're using to buy these stores and the valuations, they can arbitrage that and sometimes instantly get benefit to their shareholders by buying at a lower multiple than they're trading at. But I think the other thing is that, the big guys see that the opportunity to get bigger find efficiencies, and I know we're going to talk about efficiencies in a few minutes, given your business, but find efficiencies on the back end by consolidation. And then you've got a lot of like multi-generation dealers who are sitting out there and with all the uncertainty on the horizon about the future are saying, hey, maybe, given profitability is good, multiples are higher than they've ever been, and all the uncertainty on the horizon, maybe it is the right time for me to think about selling myself to one of these groups that's, gobbling up stores. So I think all of those dynamics are playing out for a very, very robust M&A on the physical dealer side of things.
I've noticed two things because as you know, I'm in the efficiency business when it comes to reconditioning and time to line. I mean, that's what I do. My world is that, and I see every version of it out there. So, but I see two different things. One is that some groups are saying, "Oh, this is great. Let's just kind of hold our own here, and we'll get more conservative, so we will preserve capital." And others that are out there saying, "No, we're going to take advantage of this thing and expand our footprint because we're dealing with a different competitive situation. We need to have a bigger footprint." But some of those folks are putting people in place to help drive efficiencies because process doesn't happen with a memo. I mean, it just doesn't say, okay, we want you guys to do a better job of your time to line. They not only have to get in there and hands on, it's got to have leadership, but they need help doing it too. I mean, they need people that have done this. And so we're doing a lot of that, but I'm really curious as to your thoughts about, on one hand, the statements that come out of the leadership's mouths about why they're buying this group and how much they expect it to contribute to the revenues, and then on the other end, some of them are doing something about the longer term on the efficiencies, and some of them are not. Well, I mean, what are your thoughts about that?
So I think, humans have a bunch of frailties, right? But not the least of which is kind of this recency bias, where we look at the recent time frame and then we say, oh, the future is going to be just like it is right now. But, you and I have been in this industry long enough to know that things are pretty cyclical, that these short-term effects where we have inventory shortages and these record profits won't continue. And we'll get back to an environment where dealers are under margin compression, right? The truth is the internet and transparency to consumers has been great for consumers, but has squeezed dealers' profit margins. And there's going to be more of that as inventory comes back online. So let's not lose sight of like how things are going to get back to a more normal state. And then to your point, in environments where, there's a lot of money flowing around, you can lose discipline pretty quickly. And I know, talking to some dealers, they aren't as focused on cost discipline right now because profits are good, right? So it's like, if we cut a few corners here and there, it's not a big deal. But we also know long-term, the folks that can stay very, very disciplined, focused, long-term focused are the ones that typically win in the end. So I think that, shame on anyone who isn't saying, what does the future look like in 2 or 3 years? When all the plants are back online, we are no longer talking about microchip shortages. Used car prices come back down to earth. There is inventory overflowing on dealers' lots. OEMs in many cases are overproducing, putting cars back into fleets and incenting them with all these, juicy incentives. I think to your point, at that point, the dealers that through all of this stayed very consistent and very disciplined with making sure, their cost structure and, time to market and the key metrics that you're driving are they going to be the ones that are in a much better position, who aren't like shocked. It's like, oh, we thought the good times were going to last forever. Well, they don't, especially in this industry. So discipline wins in the long term.
Do you think the fact that a lot of people are paying a lot for these cars, they're paying gross or more than gross or MSRP, and so if they're used to going to upgrading every couple of years, that may change the dynamic, I would guess, because they won't have as much equity to work with in their cars. So that 2-3 year cycle is probably going to change. Would you say?
Yeah, I mean, a couple of dynamics, right? If they're leasing the new car, then I think that at the end of the lease, like you said, I mean, they're going to suffer more depreciation than the residual value would probably reflect. So in 3 years, I might go, whoa, I'm way underwater, which means more of these cars come back into the market and the financial companies are affected. But to your point, I mean, if you're paying cash or, you're financing and intending to own it for a long time, that depreciation curve, could be pretty steep. So yeah, you could be underwater for a lot longer than, a consumer that bought a car 2 years ago, just given the depreciation curve versus what you have in terms of equity. Yeah, you're spot on. I mean, the MSRPs are, I wouldn't say inflated right now, but they're holding the MSRP when they're selling the car. The cars are going to eventually depreciate at the same rate as they would have in the past. And I think, therefore, you're going to face potentially a steeper depreciation curve, which is going to create all kinds of dynamics in 2 or 3 years.
Yeah, and we've seen something that could be a solution here to the problem of getting the efficiencies in the time to line, my favorite topic. And that is a way to bridge fixed and variable, putting them on the same page, because what they're doing, approving and investing in their reconditioning, is now being displayed on the VDP with everything else. So the customers are saying, okay, well, if you put a couple $1,000s into this car, okay, tell me why that's good, but I don't want to ask you, I want to see it.
Right.
So we're on the early stages of this, but you know a little bit about this too. And the struggle is always to get these two parts of the business, who have different incentives, to kind of play the same game. And so we're noticing now we've got something here that will help them do that. Jury's still out, but we're right in the middle of this with some pretty big groups, and we'll see how they pick it up and run with it. But I also, just kind of a comment, industrial comment, having been doing this for 11 years and dealing with thousands of dealers, there still is so much opportunity. I call it slop, but maybe that's being a little bit too unkind, but it probably is not. But there's still so much in there that I scratch my head and I say, well, this helps everybody. I mean, it makes the jobs easier. Everybody benefits. The costs are lower, all the way from the customer through to the dealership and everybody else up and down the line. But yet the industry, as you know, is resistant to change. So I think it's up to folks like you and me to kind of go out and keep making this case. And we've done a lot we're now, they say, oh, this is great. Everybody's doing a better job. They're happier in their jobs. We're making money, so on and so forth. But it still baffles me. And I guess it has to do with the history of this industry. And you've been in it a long time, there's always a pushback, first, second, and third. And then finally it's, oh yeah, this makes a lot of sense. So that's my editorial comment, because I think we're going to help put this into the mainstream now. And I think some of it's because of the M&A activity that's going on, and because these guys, the guys that are making the investments and talking to the industry about what they're going to get out of this, in terms of, they're now going to start to think, okay, I'm going to be around here. I'm still going to be around here in a couple of years, and my stock options or my whatever it is, I better make sure these efficiencies get into the organization alongside the the EPS or the ROI and so on, and the KPIs all fit together. So just kind of my little editorial in this too. Do you see anything any different?
No, I think you're spot on. Those dealers that understand which metrics they're driving towards and can stay disciplined about driving those metrics are the ones that ultimately win overall. Yeah.
We talked about this before, because I think you asked me on your founder saying, why did I do this? And having been my background in technology with Hewlett-Packard, 21 years and all that, and I said, this business can really be fun. I mean, it's really engaging. It kind of gets into your blood. And I don't know if it's because of all the exotic cars, or it's just because it's a different cat. The reason I like it is because it's a million little enterprises all trying to figure out how to get bigger and better. And so it's like a giant experiment. Uh, but I still see we're still in the early stages of getting this right. And I relate it back to my experience with semiconductor industry and all the things here in Silicon Valley that they went through to get us all these gadgets that we now live by. And you had to have the efficiency and the scalability to do that. And so, they've got it. They figured it out, after World War II and Deming and all those guys, and they kind of built in continuous process improvement. So now it's trying to help a whole industry with all different stages to kind of move down that track and, help them see what's good for them, what's better for them. And, show me you have to kind of show them the gold to be able to do that. But any other thoughts? I mean, I so enjoy talking to you because you have such a on the ground perspective of what's going on out there.
No, I think you're exactly right. I mean, I think that the sheer volume of innovative solutions coming out is amazing. I think it was a shame last year we all missed the opportunity to go to a physical NADA and see some of this stuff. But I think that coming into NADA this year, fingers crossed, there'll be really good physical attendance, and I'm looking forward to getting back. But it's one of the things that keeps the industry interesting, for you and me, is just the sheer amount of problems we need to solve and help dealers with. And as a result, the sheer number of innovations that continue to pop up every year.
Yeah, it's like a big test bed, so to speak, right? You got so many experiments going on, and I don't know. Even though a lot of acquisitions are happening, all that, it seems like it's still small compared to how diverse and how spread out this industry is. And every time you turn around, there seems to be another brand popping up or re-popping up. And then, of course, as you know and have talked about, this whole electric vehicle thing. So what's going to happen? I mean, my whole neighborhood's full of Teslas, so I've already been, and they're putting solar panels on their houses so they can push stuff back into the grid. So, sure. But now all of a sudden it's going to be another ball game. Everybody wants to have something electric, mainstream, not just let's try to get ahead of the game here with technology, which a lot of people here have done. So, give me some thoughts. How do you think this is going to unfold in the next 2-3 years?
Yeah, so let's start with consumer demand, right? So still the percentage of cars selling that are electric is very, very small. And depending on which consultant you believe, by 2030, 2035, we might get to 20%, upper bounds 50% of vehicles sold that are electric. I mean, I'm a little suspicious for a lot of reasons. Consumers still have range anxiety, they have price anxiety, and then they have, charging infrastructure anxiety. I.e., how far will the car go before it runs out of charge? And are there enough chargers along my route to recharge? And how long is it going to take for me to recharge? So all of those things we need to pacify the American consumer before they're all in on demand for EVs. But the countervailing pressure is we've got an administration in the White House now, which seems to really want to incent EV adoption. And as a result, there will be credits coming that really lower the effective price of EVs. So at least from a internal combustion versus EV trade-off, consumers may be incented to go try the EV. But I mean, beyond that, then what we're seeing is, to your point, a whole bunch of new EV manufacturers coming out, many of them going public through these SPACs, these quick ways to go public. Yeah. Some of them will flame out. Not all of them can be sustainable. But, we'll see brand new OEMs come out. A good example of which is Rivian, which is reported to come public sometime, this last quarter of the year at maybe up to an $80 billion market capitalization, which is crazy for a vehicle or an OEM that literally just, the first vehicle came off the production line last week. But be it as it may, and their intention is to sell directly to consumers, not have a dealer footprint. and therefore, because they don't have that conflict, they'll be able to sell in every state directly. So there'll be that tension. Yep. So the average franchise dealer will be saying, okay, so now I'm having to sell against EV manufacturers that are playing on a different playing field from the fact that they don't have to invest in physical dealerships as in terms of a channel. But then to your point, I think that then we see Ford, we see Hyundai, we see GM all saying that we're either going to switch 100% to EV or greatly increase the number of EVs that we're providing, because they're anticipating that the US buyer will be open to buying EVs. And then the dealer sits there and says, okay, what are the implications for me? And I think there are many implications in the service lanes around EVs. There are many implications in terms of like, how am I going to serve these customers from charging points that I need to put out front? And how do I make sure those are going to be able to accept different manufacturers who come in with different plug configurations? So there's a whole bunch of questions that dealers have about this incoming EVs, both from their own OEM as well as other OEMs, and trying to prepare for that future. And there's probably more questions than there are answers right now.
Yeah. Oh, this is fascinating, this talking about change and shop. And of course, I'm a technology nut anyway. So all the battery technology and charging technology, all that is fascinating to me. And there's a long, and the whole environment, the incentives coming down line, assuming that we can get something out of Washington, the $12,500 possible incentive. These are really significant change items. They just appear to be, this is really serious. And so yeah, we'll have to talk again in the near future and kind of see how it goes. But I think this is going to be fantastic. If I were a dealer and I'm not in there, I'm trying to figure out, how fast do I convert my operations over to support the infrastructure and things for the BEV, and there's a whole different thing, right? The batteries are expensive, the safety issue, all that. It's got to be a real headache for the dealers to try to figure out how they're going to be to not miss this, but yet make the right investments. So this is a great topic, and I really appreciate you taking the time. It's really, really great to see you again. And yeah, NADA is rolling right up here. It's going to be in March, so the clock is already ticking down here, and that new big building is enormous. And we'll be there and with bells on our toes. And hope I get a chance to sit down with you and, get up to date, see what's going on, and share some stories. But
Dennis, thanks for being generous with your time, and I appreciate you having me on today. But no, if we don't catch up face-to-face sooner, let's count on catching up at NADA. And like I said, I'm really hopeful that we have great attendance this year. I'm looking forward to catching up with some folks that I haven't seen for 2 years.
Oh, yeah. No, it's great. And I think, everybody's a little concerned about COVID and the safety thing, but it seems like they're getting ready to make sure they're doing it right. In other words, since they had to cancel the one in New Orleans. So, Stephen, thank you once again, and look forward to talking to you again sooner than later, and certainly seeing you in March up in Las Vegas. Okay.
Thank you, Dennis. It's always great catching up with you.